have been keeping a tab on what's happening in the markets right now, then you would know that since late February, Nifty has corrected nearly by 10% and Sensex has declined nearly by 8 to 9%. And depending on your experience as an investor, you may be concerned or maybe nervous. Or if you are a seasoned investor, then you would be watching this phase closely for opportunities. In Signal episode 26, we understood what is intrinsic value and how it is applied. We explored the maths, the application, the practical reality, and how Warren Buffett has applied this approach in his investing. And as it happens, markets move. Sometimes because of liquidity, sometimes because of earnings, and sometimes because of global events like we are witnessing now. Welcome back to Signal, where noisy markets meet simple, sharp, and sound insights for long-term investors. Over the last 3 weeks, what we saw was just not a market fall, but please allow me to call it a macro adjustment driven by geopolitical tensions, rising oil prices, inflation concerns, uncertainty around interest rates, foreign outflows, currency pressures, emerging concerns around stagflation where growth slows while inflation is elevated. However, India's growth story remains robust, so it's more of an inflation risk rather than a stagflation scenario. Markets are not reacting to headlines, they are reacting to the underlying uncertainty created by those headlines around interest rates, inflation, growth, and overall risk. So the real question is not why markets are falling, but how should long-term investors respond to it. My personal investing journey started nearly 28 years back, and I consider myself a long-term investor for life. So let me share how I think of this phase, my current approach, and what I am doing with it. Please note, this is not a personal advice. I'm simply sharing my approach if it helps. I invest across Indian, Australian, and US markets. In Australia, I hold a mix of direct shares, managed funds, tax-effective platforms, self-managed super fund, previously allocated employee shares, and investment properties. In India, my investments are predominantly through mutual funds, physical and electronic precious metals, and previously allocated employee shares. In US, I prefer to invest through ETFs and mutual funds. About 40% of my investment portfolio is currently allocated in India, largely through mutual funds. And this comes from a long-term conviction that I developed while working in India, supported by understanding the mechanics of Indian and global markets over time. Since early 2000s, I have continued to believe in the long-term potential of Indian markets driven by strong domestic demand, structural growth story, and evolving financial ecosystem. And I do believe that this trajectory will continue for next 10 to 15 years. But this is my personal opinion, not an advice. I have continued my SIP since 2000s, and at every meaningful correction of say around 7 to 10%, I consider deploying additional capital to take advantage of lower NAVs and favorable currency movements. So what am I doing in current situation? Firstly, I am not reacting to the fall. An 8 to 10% correction feels sharp but is not unusual. I'm not allowing sentiments to make my decisions. I continue my SIPs as it is and let them heavy lift wealth accumulation for me. Simple, consistent, and effective. Secondly, I keep cash ready. Over the years, I've learned the significance of keeping liquidity ready for next available opportunity. And I've had the opportunities to take capital off the table, preserve it, to repurpose it for the next opportunity. Many of my holdings are currently sitting at or above 100% with my initial capital withdrawn and parked for next available opportunity like current market. Thirdly, I ignore notional gains and losses, a mindset that I have internalized over the years, inspired by Mr. Market from The Intelligent Investor. I do not compare my portfolio to its peak, and this is one thing that many investors overlook. So instead of focusing on how much my portfolio has declined since January, I focus on how my portfolio has compounded and multiplied over the years. I keep my focus on big picture, clarity, long-term value creation, and informed decision making. Fourthly, I deploy gradually. I do not invest everything at once. I treat each correction as the first correction of that cycle and stagger the liquidity or capital available so that if markets were to fall, I could add more, I could invest more. Remember, better price is not a risk, it's an opportunity. And last but not the least, I seek expert guidance when I need it. My Indian portfolio is currently managed by a SEBI registered investment advisor, Himanshu, who also happens to be my brother. Managing investments across geographies while working full-time can be very challenging, and having an expert tracking markets and investments for you is of immense value. He guides me, advises me, and helps me make informed decisions. And despite nearly 3 decades of investment experience, I rely on his advice with discipline. I treat market corrections as price reset, not a signal to exit. And I'm sharing this approach to help, especially if you feel distracted, unsettled, and impacted by headlines. So, before I conclude today, I would like to leave you with this thought. Markets will always move for one reason or the other. As a long-term investor, it is not our job to predict every movement, but it is to remain consistent despite those movements. Because in the long run, it's not the volatility, but the behavior that defines and dictates the outcomes.